Hello everyone and welcome back to Value Investing Mindset. I'm trying a little bit of a different audio setup here today, so hopefully I don't sound like I live in a tin can anymore. Today we're going to be talking about one of my favorite stocks, Lockheed Martin. This stock is a really interesting one. There's a lot of value there and there's a lot of growth still that remains to be seen. And so today we're going to be talking about just a little bit of the business overview, some drivers, the moat they have, a few risks that I'm watching and concerned about, and valuation. So here I have a picture of Lockheed Martin's revenue by source. And you can see that for fiscal year ended December 2021, so like 2 months ago, 28% of Lockheed Martin's revenue came from international sources, whereas 71% was straight from the United States government and 1% was through commercial means. They have 4 business segments: aeronautics, missiles and fire control, rotary and mission systems, and space. And so inside the aeronautics segment, we've got things like the F-35, which is one of the most advanced weapon systems in the world. Also, they have the C-130s, F-16s, and F-22s, and those are the main planes that are inside the Aeronautics Division. And it should be noted that the aeronautics segment is the largest revenue segment, so it is the most important. Next, we've got the missiles and fire control business segment. Inside this, we have air defense systems, air to surface, surface to air missiles, special operations and logistics services, as well as hypersonic missiles, which is a huge focus right now from Lockheed Martin and highly demanded by NATO allies and the United States government. Then they have the rotary and mission systems, which consist of primarily Black Hawks and other attack class helicopters and transport helicopters. They have integrated warfare systems, which are essentially just comms, command control, communication, and cybersecurity systems that the United States military uses. And lastly, space. Inside space, we have a sub-launched intercontinental missile that Lockheed Martin's working on, the Orion spacecraft, which is primarily used for NASA missions, advanced GPS systems for the Air Force, hypersonic missiles again, and the next generation interceptor, which is a hypersonic missile that's meant to intercept other hypersonic missiles. So before we go into kind of their sales history, it should be noted that at the end of December 31st, 2021, Lockheed Martin's backlog was $135.4 billion in sales that are yet to be earned, but had orders placed on them already. And they expect to recognize 38% of that during 2022, which is $51 billion in sales. And 60% of that will be recognized over the next 2 years. Okay, so here we've got a chart that has their financials. So you can see from 2011 to 2021, I pulled all of this financial data, and you can see that they're growing consistently year over year. It went from 46 billion to 67 billion in sales, with EBITDA going from 4.6 to $9 billion. And their EBITDA is growing at approximately 7% year over year. Short-term, long-term debt, this is just the debt that Lockheed Martin currently has on their balance sheet, whether the payments on leases, the payments on long-term notes, all of that summed together comes out to their debt. And I didn't give them any credit for having excess cash. They consistently have about $3 to $3.5 billion in cash every single year since 2011. And the reason for that is they have that for working capital needs. They need the cash to run the business, so we don't subtract any cash from that. So if we sum their debt and their market cap together, we get an enterprise value of $118.5 billion. And if you do enterprise value divided by their EBITDA, which is earnings before interest, taxes, depreciation, and amortization, we get a multiple of approximately 13.16 for fiscal year ended 2021, 2 months ago. And we also have a net debt to EBITDA number of 1.45. So a few things to note about these numbers. I discluded $8 billion in pension liability in their total debt, but that is debt that's included in their books and that they will have to pay. So that is a risk. If there's a significant, market pullback, they still have to, pay out their pension funds. And also their net debt to EBITDA number is looking extremely well. 1.45. That's essentially saying that in 1.5 years of earnings, they could pay off all of their debt with their EBITDA. And even if you added their $8 billion in pension liability into that figure, it would only come out to 2.3. So it'd be 2.3 years they would be able to pay off all of their debt. Okay, so we put this in a forecasting EBITDA model, and I projected EBITDA to grow at 5% year over year for the next 10 years, which is very conservative. Analysts have way higher expectations, but you know how we do here at Value Investing. We like to be conservative, so that way we invest with the margin of safety. I'm using a long-term market multiple of 12.4 because that's the historical average. And so in 2031, I get an enterprise value of $181.9 billion. We less their debt, add any excess cash, but they don't have any, throw in their market cap and their diluted shares, and we get a price target of $606.55. Looking at their cash flow statement, for the last 10 years, same thing, cash flow. This thing is a cash flow monster, consistently generating cash flow year over year. Capital expenditures going from $1 billion to $1.5 billion. That's the money they need to use to build new factories, buy new machines to build new aircraft or missile parts. We have their debt payment, which is the net between the debt that they issue and the debt that they pay. So a negative number would mean that they paid more debt than they issued, and a positive number would mean that they borrowed more debt than they paid for that year. And then we get the free cash flow to equity. So this is the free cash flow that flows directly to the equity holders. This is essentially the streams of cash flow that you as the shareholder are buying by purchasing Lockheed Martin shares. And you can see also that the shares are decreasing for the past 10 years. So the company is buying back its stock, which is phenomenal. And that means that the more stock they buy back, they essentially delete that stock. And now the stock that you own is a greater proportion of the overall shares that are left. So in 2021, we get a free cash flow per share of $26.56. Throw in a price per share, and then we get a free cash flow yield of 6.8%, which is a very strong free cash flow yield. And you can also see in that last column, I threw in the return on invested capital figure, which means that Lockheed Martin is very good at investing into themselves and investing those machine parts and factories that build aircraft. Many people say that return on invested capital is a good indicator of what the long-term return will be when owning a particular stock. So I forecasted out free cash flow per share, made some assumptions for debt, and I come out with free cash flow to equity per share in 2031 of $43.30. I'm assuming a long-term free cash flow to equity yield of 6.5%, and that comes out to a stock price of $665.71. So you can currently purchase the stock in the open markets as of Friday, February 12th, 2022, which is the time of recording this video, at $396.19. We do an equal weighting on those two methods, and it comes out to a target price of $636.13. And we do an IRR on that, and it comes out to a 14% internal rate of return. So 14% on your money every single year, and that's just through the appreciation in the stock price. That's not necessarily including share buybacks or dividends, which are very strong, which we'll get into later. That is a very good baseline return. So what are some risks that I'm concerned about? Recently, there's been a lot of news about the Aerojet acquisition. So last year, Lockheed Martin announced that they wanted to buy this company called Aerojet, and they were going to buy it for $4.4 billion, financed mostly through debt. And Aerojet's a rocket propellant and engine manufacturer, and their strategic rationale for purchasing this company was that they believe it would expand their ability to develop hypersonic weapons and defense systems much faster. But as Uncle Sam does, they get in the way sometimes when people are getting a little too big for their own good. So the Federal Trade Commission was a little concerned about monopolistic practices, and so they are making the argument that it would give Lockheed Martin the ability to cut off defense contractors from critical components that they themselves need to build competing missiles to Lockheed Martin. And so they're doing that to protect the United States government, because if Lockheed Martin just keeps growing and growing and growing, and it comes to the point where they're the only person who can build hypersonic missiles, then they could essentially charge the United States government whatever they want, and kind of rip off the government. However, I will caveat all this by saying that, although it's kind of a bummer, if it does get blocked, Lockheed is going to fight this in the courts. We'll see what happens, and it's not like a game changer detrimental if this acquisition is blocked. It's just a sweetener if it's approved. There's only a handful of defense contractors in the United States, and it's incredibly hard to enter the industry. Lockheed Martin owns the United States Air Force favored fighter jet, and NATO favored fighter jet, the F-35, and it is the best aircraft currently that we know about on the market. The other great thing is that government contracts provide predictable revenue streams. They win a contract, they know exactly how much money they have to work with, and they can forecast that out every single year because they'll know the demand for that particular contract. And also, the F-35, which is the majority of the firm's revenue, well, that contract ends in 2070, which is 48 years from now. So to put that in perspective, I'm 25 plus 48, that means I'll be 73 by the time the F-35 contract expires. And the other thing that's of note is that defense contractors play a role on a country's defense budget. And the defense budget is essentially a function of a country's wealth and their perception of danger. So as long as the United States continues to grow and remain generally wealthy, and as long as threats exist out there, which there's always bad guys and there's always reasons that we'll have to want to defend ourselves, there will be a purpose for defense contractors. So it's not expected that Lockheed Martin is going away anytime soon. But with that being said, there's always political risk to defense budget. I mean, we always hear how much the United States spends on our defense budget every single year. And to be honest, I do believe it's pretty high. I'm sure we could use those resources to do other things. But at the end of the day, the government is the government, and there's a lot of politics involved, and it's not as cut and dry as we'd like it to be sometimes. So there is a political risk, and if people lobby and try to block defense spending, that could potentially hurt Lockheed Martin's future revenues. There's execution risk on their contract. Contracts are great because they're predictable, but they're bad because it's a fixed price that they receive from the government. So if their baseline costs increase, like they kind of are right now from inflation, it could hurt their margins in the long run. So let's look at why I think there's some short-term and medium-term drivers at play here. So the 2021 return on invested capital was about 33%, and the index for defense was 18%. So they almost have double the index of their return on invested capital. So you're buying a company with great management who knows what to do with shareholder money. Right now, their price to earnings ratio is around 17, and the index, the industrials or defense indexes, are at 22. So Lockheed Martin is 5 ratios below the index, which is a pretty good indication of value. Their price to cash flow ratio is 14.6 and the index is 16.9. So 2 ratios below the index. And they've consistently increased their dividend for the past 10 plus years. Their dividend currently yields a solid 2.68%, and the buyback yield is around 3.79%, which is non-taxable because they're just buying back their shares and deleting them. The dividend counts as income if it's in an ordinary taxable account. So the total yield from financing activities on the cash flow statement alone is 6.47%. And by comparison, the index yield from the cash flow statement is around 4.37%. So we're 2% higher than the index, or you could almost argue that we have 50% more return from the cash flow statement than the index. So ladies and gentlemen, a 14 to 20% upside return for Lockheed Martin is pretty attractive to me. I don't know about you. Just know that this is not financial advice. I'm not a licensed financial advisor. I'm just a guy who likes to research stocks on a Friday night. This video requires a lot of effort, so please leave a like, comment, subscribe, and turn that notification bell on for future videos. It means a lot to me and gives me the motivation to continue to post more videos. Although the market could be viewed as pretty expensive right now, and there's some short-term uncertainty and volatility regarding what the Federal Reserve will do with interest rates in the near future, there's still bargains to be found. Lockheed Martin is one of them. Full disclosure, I purchased the shares at a much lower price, around $340 per share, and right now the current share price is $396. So just keep that in mind. For me, I don't think I would want to buy the shares now because, there's the higher the share price increases, the more your risk is, and I'm really happy with where I bought them, and I'm not averaging up, although I will invest dividends. That's all for me. Everyone have a good night. Have a happy Super Bowl weekend. Enjoy, have lots of food, and until next time.